All right, what's up, everyone? This is Kirk here again at Option Alpha. Welcome back to another live workshop with us here today. Today, we're going to be doing a really important one. This is a super important topic. I want to spend a lot of time revisiting because we talk about it at length all over the place. But I think that this new session that we're going to have today, where we talk specifically about bot portfolios and show you how to integrate your bot portfolios with position sizing and allocation and distributing trades and ensuring that you have those right positions in place, laddering into positions, like showing you how to do that. I think all this is going to be a really, really helpful topic. So, what I would ask of you if you're watching right now to number one, really dig into this topic. That is the best thing you can do for yourself, for your portfolio, is to not try to cut corners and try to go around the math and the logic here, like really dig into this. And then number two is try to take what we're going to do today and try to incorporate it into your automated portfolios moving forward. So build out a simple bot. I will give you guys examples and templates at the end of this session, and we'll link those up in the community and on the workshop page, etc. So you can have those, but use those to actually build something out. So that's the only two things I ask. One, just please dig into this. This is a super important topic for you and your portfolio, your family, like being able to survive and in this business. And then two is do it, like actually build something out. I'm going to try to give you as much as I can and push you as far as I can, but you actually have to do it yourself too. Okay, so here's what we're going to do. So I got a couple slides for you all today. This is a different topic than you guys are used to, but I'm going to try to weave in a bunch of this as I possibly can. We're all here focused on crafting bot portfolios for safer auto trading. And the reason I use the word crafting, just so you guys know, is because it is a little bit of a craft. It is something that you should do, that I try to do, where there's no perfect model or situation. There's no, you have to do this and it has to be this and it only can be this way. We don't work like that. And I'm sure you guys don't either. Working with your portfolio is a little bit of craft, right? There's math and there's some logic behind what you do, but some of it is a little bit of craft. So I use the word craft here on purpose, okay? So workshop overview for today. Number one is discuss broad portfolio management concepts around allocation, position sizing, cash reserves, etc. I really want to start high level and then work our way down as we go. Number two, we're going to walk through multiple examples of how to calculate position sizing and how to do it correctly. It's actually fascinating to me that people still over allocate positions. It's the easiest thing in the whole world to do. It's even easier now that the bots can do it for you, but I don't know why that becomes an issue. So we're going to do it again, and we're going to keep pounding this until it gets through, because I think it's one of the most important things you can do trading. And the last thing is, and we're going to spend a lot of time on this, is show you how to set up your bots and automations to run automatically and check position size and adjust position size dynamically. I'm going to do a lot of examples here today with a couple automations that I pre-built for you guys that we can also use moving forward. If that's good for you guys, I'll post them in the community so you guys have them as examples. But I really want to work you through this process and show you how to stress test it and show you how all the checks and balances work with your bot. So here's what we're going to start with. We're going to start high level, like I said, okay? And just conceptually talk about how do you allocate a $10,000 portfolio, right? That's the average brokerage size that people have, by the way, is a $10,000 portfolio, right? So if you're around there, a little bit under, a little bit over, great. That's about the average nationwide. How do you slice and dice this thing out, right? That's probably one of the hardest things to try to figure out as a trader. Is like, I have this pot, this kettle of money that I would like to allocate. And I want to do it smart, and I don't want to do it stupid, and I want to be intelligent about it, but I know I want to risk money to make money. I can't just sit here with my money. So how do I do it? The rule of thumb that we like to use here, and this is part of that crafting. It's not set in stone, but it's a good rule of thumb, and there's some logic behind it, is we like to say that you should allocate 1 to 5% per position that you have. Now, let me clarify this really quick, because sometimes we might use different terminology, but I want to be 100% clear here. I think when you start dividing out your pie, 1 to 5% means per ticker symbol. per thing that you're going to be exposed to. So if you love Tesla, I highly suggest you don't put more than 5% of your portfolio into any Tesla position. That's the combined positions of all the positions you might be trading in Tesla. So I visually represent it like this. If you have this pot, this portfolio, then each part of that portfolio, each little micro allocation is no more than 5% of the total portfolio, which is $10,000. So if you have a $10,000 portfolio, you could put 5% into SPY. 5% of $10,000 is $500. That is the maximum amount of risk that any and all positions should carry for SPY. I know because I can see everything that people do, right? Like all the broad numbers and stats on the platform. Most people do not do this. The vast majority do not do this. I don't know why. Now, here's what I'll also tell you. Little inside secret. If most people, this is broadly, right? Like most traders don't make money, right? You guys hear that all the time. I really believe that position size is the root cause of it. I will stand on this hill. I will die on this hill that position size is the root cause of it. And I'm telling you guys right now, because this is why I'm doing this workshop with you. So if you're here and it means something to you, and I think it does because you're here, you're watching this, then you will know most people do not appropriately position size. Happens all the time. And actually people are like 30, 40, 50% allocated to a single ticker or a single position. And then they lose and they wonder, why does that happen? If you allocate 1 to 5% per ticker symbol, that's your goal. That's like your North Star metric, 1 to 5% per ticker symbol. So if you have one trade in gold in GLD, that one trade has to be $500 of risk or less. If you have 2 trades in gold, each individual trade should be $250 of risk or less. So one trade, I'll just even write this, one trade equals $500. If you have another trade in gold, right, or you want to do 2 positions in gold, great, do 2 trades. But they each have to equal $250 so that the combined is $500. Now, what I would like to do, and the reason I put this out here like this, is what I would like to do is I would like to suggest, not advice, suggest or educate, however you want to do it, okay, is I would like to suggest that your smaller one-off type tickers and positions, etc., are on the lower end of that spectrum. Your Teslas, your Metas, your whatever. Try to gravitate towards those 1%. The higher, more bigger ETFs and bigger products like SPY, TLT, etc., you could probably gravitate towards the higher end of that spectrum. So the starting portfolio value here was $10,000. And then this is how you might kind of break up your portfolio. This is just on position sizing. This is risk. Okay, so here we go. Here's why. So let me just show you this chart. You can take a screenshot of this chart, but the reason or the way that you can calculate this and how you can do it for your portfolio is you can find what your portfolio account balance is, right? And then you can find your risk per trade. And when we say trade, we mean ticker. So we could, you could rewrite this if you want to and say it's actually per trade, per ticker, if you want to call it symbol, something like that. Symbol, ticker, right? Whatever you want to call it, whatever that is for you, however you say. No more than 5%. I call it per symbol. You can call that a trade, a position, an allocation, whatever you want to call it. All right, next slide. Here's the reason why we do it. Do you guys want to know the reason why we do it? It's very simple. It's because we want to be the casino. It's really simple. I talked about this a lot. There's podcasts and webinars on it, topics I've gone through, but it really comes down to this very simple concept, which is that we want to be the casino. And if we want to be the casino that always wins, then one of the things that we have to do is we have to try, because it's not impossible, but pretty much, you can pretty much get there, is eliminate the possibility of going lights out, of going broke. That's what we want to do as traders. As a trader, the thing that will stop you is you going broke. Like if you run out of money, can you keep trading? Answer, survey says no. Right? The thing that will stop you for sure, 100% dead in your tracks, is losing all your money. So how do we not lose money? Well, we know we're taking risk, and we know that we don't predict the markets. We don't know where the markets are going to go. We can have some idea around probability of success and position sizing. These are things we control. If we control certain things and we don't control other things, how can we maximize our chances of living and continuing to fight and trade another day? All right. So as a trader, we don't control some things. We don't control the market. We don't control the Fed. We don't control the reaction of other traders. We don't control COVID or Ukraine or Russia or whatever, right? We don't control lots of things. We do not control the sequence of returns that a strategy has. It's like saying that we could control the outcome of coin flips. So if we flip a coin, we could get heads or tails. But here's the key. I don't know if I flip that coin 10 times that I will get exactly 5 heads and exactly 5 tails, because I probably won't. I might get 8 heads in a row, and I might get 10 heads in a row. Now, the probability of getting heads or tails is 50-50, but that doesn't mean that I control the distribution and the sequence of those heads and tails as it works towards 50-50%. So here's the thing that we don't control. We don't control sequence of returns. I am telling you right now, sequence of returns, wins versus losses, and how they're distributed out is the killer of traders. If there was like a writing on the tombstone of a trader, the writing would be this trader was killed by high position size and sequence of returns. What we don't control is we don't control that if, and somebody had a good question here, what if I enter 90% probability of success trade? Well, that's great. That doesn't mean that the trade's going to be a winner. It means you have a 90% chance of success. You could enter a 90% chance of success trade 10 times in a row, and there is a chance that you lose on all 10. 90% does not mean 100%. There's a big, you guys know this, but people, when you actually start putting your capital at work, you don't really think this. This is why I'm doing this, why I'm so passionate about it. 90% does not mean 100%. 90% means if you have 1,000, 2,000 occurrences, you should get 90% winners. But the first 10, the first 20, the first 100, 200 may not be 90% winners. So here's why position size is important. Because when you have a small position size, you start to eliminate the possibility, let me call it the possibility, of a sequence of bad returns killing you. Specific example, this one right here. Let's talk about this one right here. If you are trading something that has a 50% probability of success, that's a coin flip. If you are trading that has a 50% probability of success, the chances of you losing on the trade is 1 in 2. That's 50%. Half of the time you're going to win and half of the time you're going to lose. So the chances of getting that first loss is 1 in 2. Now let's go here. What are the chances with a 50-50 bet that you lose 2 trades in a row? It's 25%. There's a 1 in 4 chance that you lose 2 trades in a row. So if you flip a coin, there's a 25% chance that if you flip that coin twice, you're going to have 2 losses in a row. Here's why it's so important. If you allocated, just in the most extreme example, 50% per trade, how many trades does it take for you to go broke if you allocate half of your portfolio, in the most extreme sense, to every trade that you do? So think about this. I know this is challenging. I told you in the beginning, I am not here to make this in super. This is a challenging one, and you got to lean into it. So if I allocate 50% of my account towards every trade that I do, it takes 2 trades for me to blow myself up. So if me and you were betting on a coin flip, heads or tails, and I said, I bet it's heads, I'll bet 50% of my account that it's heads. So you win if it's tails. We flip the coin twice, it's tails twice, I lose my entire account. I bet 50% the first time, 50% the second time, and I'm wiped out. Now, if you start, and this is why I like the combination of this as traders, okay? The likelihood that we blow ourselves up is about 25%. Like just starting out, you've got a 25% chance you're going to blow yourself up if you trade 50% of your account, because that's the likelihood of going broke. It only takes 2 trades. Now, if I cut this down and I cut down my allocation to 20% per trade, then I need 5 consecutive losses in a row to go broke. It's just math how we're working that out. If I allocate 20% to 5 individual trades, and all 5 of those trades go completely bad, full loss, max loss on the whole thing, I have now gone broke on 5 trades. The likelihood that I do that, if we're trading 50-50 odds all the time, is 1 in 32. Now, 1 in 32 is now a reduced chance of going broke, of blowing yourself up of about 3%. That's a significant reduction in your chances of blowing yourself up just by cutting down your allocation. If we just slightly tweak the trades that we enter, which is why I love options trading so much, okay? So one of the reasons why I love options trading so much is because I don't have to trade 50-50, which is what happens with stock trading, right? Like you're kind of buying and selling, and maybe use some technicals, and that's good and well, but you're still like mostly 50-50. But with options, we can really allocate some pretty serious capital to higher probability setups. If I'm allocating 5% of my account per symbol, think about it, 5% of my account per symbol means that if I had a full portfolio, 100% allocated, how many symbols would I be trading? That means I would need 20 losing trades in a row if I was 100% allocated across the board. And let's just even go further and say, let's say I was 100% allocated in the same direction, like they were all bullish positions. So if I had, now just really quickly, logic on this, right? So just follow me along on this. If I allocated 5%, which is the max that I recommend. Remember I said I recommend personally 1 to 5%. The lower you go, the better. And that's max risk. We'll calculate it here together. Then I would need all 20 symbols to lose in a row. If I'm trading at a 70% or targeting somewhere around a 70% chance of success, might be 68, might be 72 in some cases. Maybe I'm taking trades off early for profit taking. The likelihood that I go completely, absolutely broke and lose all money is 1 in 28 trillion. Now, it could be a little bit lower, a little bit higher, depending on some correlation stuff, but raw numbers, concept-wise, do you see the trajectory of where you want to go? That doesn't mean you have to go to 90% probability of success, but it certainly means that you shouldn't go to 90% probability of success with 50% of your account per trade, because that still has an opportunity to blow up your account. So look, you want to gravitate towards these. Higher probability, doesn't have to be the highest probability, higher probability, low position size type trades. It is purely math why those traders stay alive and potentially win longer term. It's the same reason why casinos, do you guys know why casinos have table limits? Do you know why they have lots of games all over the place? Because they care about occurrences. They want a lot of occurrences, and they want small position sizes, because that's good for them, because they don't blow themselves up. They're playing the law of large numbers. So use those same rules for yourself. Now, here's another thing that's actually really important on this. This is just assuming all those positions are bullish. So if you start mixing bullish and bearish, neutral trades, now the sequence of return thing is even less and less important, as long as your position size is small and as long as you've distributed across multiple ticker symbols all over the place. When I talk about having different position sizes and different ticker symbols that you're trading, one thing you have to consider is correlation. For example, and this is a slide I took literally today, I took this screenshot. The S&P, which is SPY, is this blue one, and the yellow one is the Russell IWM. For all intensive purposes, it's the same thing. It really doesn't matter if you trade IWM or SPY or DIA, right? They're all pretty much the same thing. So if you tell me, Kirk, I have a diversified portfolio of SPY, IWM, and DIA, I would tell you, no, you don't. You have a highly concentrated portfolio of market index ETFs, because IWM and SPY and DIA virtually move the same. Now, this doesn't mean that you cannot trade those together. That's fine, but just realize what you're doing. If you allocate 5% to IWM and 5% to SPY and 5% to DIA, you've got a 15% position on the market. And you just have to understand that if the market goes south, you risk losing that 15%. So what you want to do is you want to figure out what baskets of ETFs have more uncorrelated profiles than other. Is everything going to be perfect? No. You will never get a perfectly uncorrelated basket of securities. But what you can do is you can at least not trade the same market indexes all over the place. And notice here, this is just SPY versus FXI. Notice that what you're looking for is you're looking for baskets that don't always move together. They may trend sometimes together, but they don't lockstep move together, because what that does is it creates opportunities for you to get lots of sequences of returns baked into one environment. When you have an entire portfolio that is moving together because it's all the same stuff, you are condensing your sequence of returns, right? Your consecutive losses, you're condensing it down to a very small time scale. And this is where you hear people blowing up after like a 10% move in the market. Okay, so let's start getting into this. When you are pulling up a ticker and a trade, the most important thing you can do is figure out how to calculate risk. So guess what? We're going to walk through this together so there's no question in your mind as you go how you calculate risk. Because we trade everything risk defined here on Option Alpha, it makes it super easy. Everything is defined risk. It's 100% defined in the position. As you pull up a new position, and this is the new position screen in Option Alpha anyway, you'll see that we list some metrics here. So in this case, what is just, and forget the model portfolio for a second, what's the risk of this opportunity? Okay, if you answered C, you were right. Now look, here's the thing. I don't know why other places don't show this more prevalently, but we do. We calculate it for you. You take the width of the wings or the largest wing, you subtract out the mid price of the credit that you might receive, and then you get your max loss. So we put that right here for you. Do you guys see that right there? That's your max loss as you go. There's no question what the loss is on a position. Now, if you increase the number of contracts, that will adjust as you go. It's very clear. It's very simple. Now answer this question. If you have a $7,500 portfolio and you wanted to risk 2%, let's call it per symbol, how many contracts of this trade can you do? 1, 3, or 5? Do you know what the answer to this is? 0. You can't do this trade. Sorry, it was a trick question. There is no answer for the right answer because the answer is 0. You cannot do this trade. This is the problem, actually. I'm not going to pick anybody out here, but I'm telling you from what I see with millions and millions of contracts and traders go through, and we like see the stats on this thing. Like they're allocating too much because they can't figure this out. Okay, you ready? Here's the math on this. I have a $7,500 portfolio. You multiply that by the risk per symbol that we wanted to target, which in this case was 2%. So you do 2%, and then you do equals. That means that one symbol, SPY, can have no more than $150 of maximum risk. That position we were looking at has how much risk? $333. And your rules are, I will not allocate more than 2%, just as an example. Then that means that you cannot get into this trade because 333 is greater than your $150. So either A, find a different trade, or B, reduce the wings of the position. So what you would want to do in this case is you would want to find a different trade or make, these wings. See these wings here? They're $5 apart. You'd make those wings tighter. And by the way, when we do this on Option Alpha, when you start to adjust these wings in these positions, which is why we added these things here, you can start to see your max loss get into the range that you wanted it to be in. All right, let's do this one. $50,000 portfolio, 2% per position or symbol, however you want to call it. Let's call it symbol just to keep the logic the same. All right, and the answer is yes, B. Just takes one time, and I bet it's ingrained forever. That's my hope. I hope you walk away from this and you're like, I've figured out how to calculate position size. Walk through the math. You do $50,000 times 2%. That's no more than $1,000 of risk per symbol. So if you wanted to do all 10% on this trade right here, then you would do 1,000 divided by $333 of risk per contract. Means you could do 3 contracts, right? Because this is just one contract right now. So you could do 3 contracts. Or you could break it up and you could do 1 today, 1 tomorrow, 1 the next day. But at any point, no more than $1,000 of risk allocated. And yeah, you can break it up however you want. You can do all 3 today, or you can break it up. I'm going to show you how to do this inside your bots too as we go. All right, so let's switch over now, and I'm going to switch over to the platform. We're going to go through this together with lots of examples. Let's go into trade ideas, not because we have to be in trade ideas, even though they're awesome. Okay, but let's just filter for some stuff, and I'll just pull some stuff up. If I wanted to allocate to this trade, I'm just pulling up some trades just so you guys know. Okay, let me pull up this trade right here. Okay, I'm going to do the math with you together on the side. But let's say I have a $5,000 portfolio and I want to allocate to this individual position 3%. How many contracts could I do? Just one, right? Because 3% of $5,000 for SPY is $150. So the max loss on this is about 151. You can get a little bit massagey with this. This is crafting, right? Doesn't have to be perfect, but you can do one contract here. That's great. That tells you how much you can do. Now, if I had a smaller portfolio, and let's say my maximum risk had to be no more than $100, then what you can start to do is you can start to play around with the different strikes that you have and start to get that down under $100. And look, just figure out whatever works for you. This is probably not high probability enough. Let's go out here like this, something like this, right? Until I get something I like, but now it's under my max loss. Let's say you want a bullish trade. You want a bullish trade in EFA, or let's do this one. Here's a better question. Okay, this will be a really, really good question. If this trade represented 5% of your account, like this symbol here represented 5% of your account, how much money would you need to have to enter one contract? I feel like a math teacher at this point. That one made me feel like for real, made me feel like a teacher in a classroom, but I hope it helps for you. But now I'm going to ask you to reverse to make sure it sticks. How much money would you need to have if this trade represented 5% of your account? And let's round it down to 390. So if you've got 390, how much money would you need to have in your account? It is $390 of risk. We are going to divide this by 5% because $390 has to represent 5% of something. And now we do equals, it's $7,800. Here's the deal. If you're not doing these calculations and know where you generally stand, just do it a couple times, know where you generally stand on positions, right? And then you can know as like a frame of reference, every position for me needs to be under 250 and every ticker needs to be under 750 or whatever it is for you. Find your breakpoints of how you want to get into positions. Let's take it up one notch from here. So I have this demo bot that I put together just for our time here today. I want to run through lots and lots of scenarios with you guys so you guys can see how this works, because I think it's the most important thing that I can do for you and your trading. I will share these automations in the community once we're done here today. They are not meant to be traded. They're meant to be used as education. They are not meant to be traded. It's a concept of education so you can understand how they work. Your bots are set up to have these safeguards, like total allocation and daily limits or position limits or et cetera. So what I want to do is I want to go through this slowly so that we all understand it. So let's start with the most basic denomination that you can do, which is if you wanted to, you could build a bot that trades one ticker symbol. This is what I do with a lot of hexabots. So I would have a bot, and notice here's how I do it. You can see my hexabots. I have each hexabot is just focused on one symbol. That's one way you can do it. I'll show you multiple ways as we go. But let's say that I have this bot that's my SPY bot. And this is all my trading in SPY. Now, if I've got a $10,000 portfolio, so to go back to the original slides, right? I've got a $10,000 big portfolio, and I want how much in SPY? 5%. What is my total allocation here for SPY? The total capital to open new positions, $500. That's my allocation, and I save my max allocation. This is now linked directly, $500 allocation to SPY. I'm building a bot just to trade SPY. The only thing that will ever be in here is SPY positions. So now the bot is limiting the capital right here. This is part of the way that we architect the bots for you. Tried to explain that a couple of times, but without the context of the portfolio, there's no, it's like, why does a bot have an allocation? This is why the bot has an allocation. Because I think most of the time you should be trading regular tickers, like one ticker bots. You can trade multi-ticker bots, but it's really easy. You can still set your daily position limit to one position per day and one position opened at any time. And that would be $500 max for that one position of risk. So here's what we're going to do. I have a couple automations here that I built that are just used for testing as we go and running. Okay. They're not meant to all be run at the same time or anything. Notice I have automations off. So inside of this automation, this is one symbol, 5% position size. Okay, 5% position size. I'm going to challenge you guys on this as we go. I am looping through one symbol. That one symbol is SPY. By the way, you can add a symbol loop and just do one symbol. You don't have to actually do more than one symbol. There's no need to do it. You can do it in one if you want to. And I'm doing any checking I want to do. Like this is just a placeholder for anything. You want to check technicals or IV rank or whatever. You check all the stuff you want to check here and you check it. So I'm going to delete this. I'm going to keep the rest of the path. Here's how I would put together a lot of bots. Most of the bots you see that I do are put together like this. I have the bot ask a series of progressive questions, and we will eventually get to the point of opening a short put spread. So I would tell my bot, I would ask my bot to say, can the bot open a new position? That's an easy one, no brainer one. Like, did I already open a position? Do I need to open a position? Ask it. Yes, you can open a position. Does the bot have exactly 0 positions with this symbol? Another very easy one if you only want one position per symbol. And I will show you multiple examples of how to do multiple positions per symbol as we go. I have lots of examples, but I'm starting very simple. The bot has exactly 0 positions with this symbol. Why is that important? Because maybe you are religious about position size like I am, and you don't want the bot to ever open more than one position. Now, you've already kind of accomplished that in the safeguards, right? So let me go back to the safeguards. One position at a time, one position at any one time, but it doesn't hurt to also add it in here too, okay? In case this automation gets used other places. Now what I'm going to do is I'm going to have the bot check and see if the position I am targeting is available. Now I threw in just for fun and giggles, that we were going to try to enter a short put spread 30 days from expiration, right? Here it is, short put spread, 30 days from expiration. The short put delta is about a 30, and the long put is $1 below the short put leg exactly. That makes it the tightest possible spread that you can do with about a 70% chance of success. That's just the one I used across the board just as a good example. But that's one of the ways that you can help kind of control position sizing is ensure that you're only entering trades $1, $2, $3 wide, whatever works for you, right? We saw earlier in the class or the workshop that when we entered a position $5 wide, we sometimes got a risk of around $300, right? Just depending on the premium that you get. So if you enter a position $1 wide, then your risk is going to be no more than $100 per contract that you get into. All right, so the first thing I want to do is I want the bot to check, is that position even available? Which really means, is there even something available 30 days with exactly $1 wide strikes? The very deliberate process that I want the bot to go through. All that being said, that was kind of like a little precursor to the last part stuff here. Here's what I want to do here. And this one, I want to stress test you because I see this all the time. And I feel like if I don't do it this way, I don't know if you'll learn. I put in here that I want the bot then to check to see, and this is a very simple recipe. This is a bot capital recipe. The bot has available capital to open 5% of allocation of that same short put spread that I was looking at 100% of the bid-ask spread. Look, there's a reason why we added this recipe. This is your mega recipe to check and see if the bot has enough capital to open a position. It ensures automatically that you are allocating within your parameters that you set. But here's the thing. On this particular recipe, the way that I have it set up here, I deliberately changed something because I want to see if you know what it is that is wrong on this recipe. Think through this. This is really good. Your max allocation in the bot, you already cut down to 5%. I'm telling this is actually one that's tricky. Like there's no way for us at Option Alpha, we can't allocate capital for you. So I just have to teach you how to do it. But you already cut down your allocation to 5% already. This is your 5%. So you've already given this particular bot 5%. This bot already has that 5%. So what you can do here is you can, and I'll adjust this as we go and we can do this, is you can say 100% of the bot's allocation because it's already adjusted down to 5%. So if I say 100% of allocation and you see somebody's automation and you're like, oh my God, they're using 100% of their allocation. Well, it's probably because they're adjusting their bot like total allocation down. So if I do this now, let's say I have a $10,000 portfolio and I say, hey, I want to allocate $10,000. Should I leave this allocation at $10,000? No, I can leave this allocation at 5%. So do you notice there's actually a lot of ways to kind of skin this cat depending on what you want to do. I like to do it different ways depending on the different bots, but it's really easy to allocate for it either way, whatever way works for you. But here I'm doing 5% because I know that my whole portfolio is here. And guess what? I'm still limiting it to one position. So I'm still good. I can still run an SPY bot, say my portfolio is $10,000. It's not for the SPY, but it's going to only limit it to one position at a time. Now, after you check and make sure the bot has enough capital available, so this is your check and see if my bot has capital available, then you can enter the position and you can just match up your position size here too, right? You can say, okay, I will allow you to get into a 5% position. Now, I don't suggest that you start all your bots with $10,000 or $100,000 or whatever. You do you, whatever works best for you and your different bots that you're running. Let's do 3% position size. 3% position size is no different than 5%, except the only thing I did in this automation is I changed the allocation from 3%, from 5% to 3%. That's it. I did nothing else. I just moved the one allocation field here to 3%, and I moved the one allocation field here to 3%. Now watch this. Let's do some testing on this, okay? So I built these. These are one and the same, except one uses 3, one uses 5. You could use a custom input for it if you're really advanced, but I just wanted to show you guys how it works, okay? Let's readjust this allocation down here to $250. Let's go super low. Like my allocation for SPY is $250 max. That is it. That's the top of the spectrum. Actually, let me do this. I'm going to do this. Let's keep it at $10,000. I can test this allocation here of 5 and 3% by just clicking on this and running a test for 5%. And I can start that test and it will go through and it will say things like, is this position available? Yes. Does the bot have enough capital? Yeah, because 5% of my $10,000 is what? $500. 5% of $10,000 is $500. And the bot has way more capital available than it actually needs for this position. So it would open a position. Now, if I were to reduce this down, let's say to $3,000, and then I run this test again, you see how you can just test it back and forth? Now, if I reduce this down to $250 and I kept that at 5%, then I'd run a test and obviously this one would fail because I don't have enough capital. 5% of 250 is $12.50. So let's do this. I'm going to test this out and I'm going to run a test on 5%. This would not open a position, right, in my test environment because 5% of my $1,000 is $50. I need $79 to open this particular contract. So look, if you test it and it doesn't work, you should probably adjust and refactor this. But here's what happens for a lot of people, okay? What a lot of people do is they somehow try to get into a position like SPY, right? And they try to get into a short put spread. That's about 30 days, the monthlies. We're going to do the short put at what, a 30 delta, something like that. And we'll do the long put $1 below. So $77, right? and you will try to get into this position. Now, is your bot going to allow you to manually open this position right now with $1,000 of risk? Yes, 100%. It's going to allow you to open this because you're doing it manually, because you don't have any check and balance. You are the check and balance. The only check and balance that you have if you try to open the position manually is if you try to open 100 contracts for $7,000, you're going to get an error on this position. Not enough capital available. And that's good. That's okay, right? That shows up in your bot right here. And you just got to make sure you clear those out as you go, right? You had that warning because you don't have enough error. Now, if you're running this automation, and let's say that you want to like really run this automation, watch this for a second, and try to get into this position. We're going to run our 5% automation, right? Remember that's that 5% position size. We know we don't have enough capital. It's going to run the automation, and then it's going to stop. And it physically ran the automation. Look in your log here. You can see went through 4 decisions, and it stopped because it doesn't have enough capital. Now, if I went in here and I upped my capital to $2,000 and I ran this automation, not test, run it, again, it should enter a position. Why? Because 5% of $2,000 is $100, which is more capital that is allowed for a new position. So guess what it tried to do? It's trying to open a brand new position. And it's only doing 1 contract. That's it. Because that's how much it has available to do it. It was calculating it for you as we go. It was calculating 5% and making sure it was less than 5%. Okay, I'm going to cancel this so it doesn't get in. Let's take it one step further. All right, you ready? This one's going to be a little bit more aggressive. All right, let me see which one it is. Yeah, it's this one right here. I built out another automation for you too. This one's different. And I'm going to challenge you on this one. I don't want to share it with you right this second. But I'm going to challenge you on this one for the concept that we're going after. Okay, and then you have to tell me what we have to adjust. Let's remember before we dive into this automation that we have an allocation of $2,000 is just what we have set now. 1 position per day and 1 position at any time. And let's call this one a portfolio bot. So this bot, I don't want to trade a single symbol. I want to trade multiple symbols in this particular bot. Okay. You can do that inside of a scanner. I built out a simple demo one for you called multiple symbols, 2% position size per symbol. So I will allow the bot. Here's what this one wants to do. This scanner will allow the bot to get into 1 position for each ticker symbol in my loop. 1 position for each ticker symbol in my loop. And I'm setting it up so that 1 position is 2% of my total portfolio. 2% of 2,000 already is not enough cash. I think you guys are seeing that. So if I want to get into 5 different tickers, and I just put in my symbol loop here, 5, decently uncorrelated ticker symbols, SPY, TLT, GLD, XLE, XLU. Utilities, energy, gold, bonds, broad market. I'm not saying you got to use those. You could if you want to. Okay, but I put in 5. So I want 5 positions, 5 individual trades, 1 per ticker symbol, 2% each. If I am fully allocated, I will be at, for those 5 positions, I will be at 10% of my account. All right, let's keep going here as we go, and we'll back out and we'll adjust our capital as we go. Again, you do all of your, whatever you want to do here is totally up to you. The symbol price is above a moving average, whatever is your trigger for entering. IV rank, RSI, Bollinger Bands, whatever. Okay, so I'm going to delete this. You guys good with this? It's just, that was the placeholder for where that stuff lives. It doesn't have to be the same forever. Same logic applies. Can the bot open a new position? Yes. Great. The bot has capital, has not reached position limit, so it can open a new position. Awesome. Does the bot have exactly 0 positions with that symbol? So what would happen if you have a position with SPY? Where does it go? It would go down no. The bot does not have exactly 0 positions with SPY. The bot already has a position with SPY. So if you have a position with SPY, it would end here and it wouldn't open a new position or TLT or whatever. So it's going to loop through all those. And I'll show you how it works. We'll do a demo trade, like a paper trade, and then we'll run the logic all over again. Now, if you can open a new position in that symbol, then we do the same thing. It's the same logic applied here, right? It's actually just, it's the same logic applied. It's very simple. We just added more symbols to our loop. Is there a position available? Yes. Can I allocate 2% to that position for that symbol? Yes. Great. Open a position that's 2%. So if I know that a $1 wide spread was roughly, let's call it $80 of risk, roughly $80 of risk. So you know that each position is going to be $80 of risk. And you want that position to be 2% of the total portfolio. So I divide 80 by 0.02, which is 2%, or you could do 2%. That means that each symbol needs to have $4,000 of capital allocated to that bot. $80 is the risk on average for that $1 wide spread that we looked at. So if you go to that spread, it was a $1 wide spread we were telling the bot to search for. A dollar wide spread should be about $75 to $80 if you're doing a 30 delta. You can test it out in a trade idea first and just see kind of what that is. But that's about $80 of risk for one spread contract. So I do $80 and I divide that by how much that $80 should represent, which is 2%. So every ticker needs to have $4,000 of capital available just to do the 2% position. How many tickers did I have in there? Because I'm doing one trade per ticker. I had 5 tickers. So now I multiply that by 5. I need $20,000 to do those 5 trades. So you guys see how we got to a $20,000 allocation. How we get to, I can say, a $20,000 allocation. I can update this, and I can update this to say $20,000. Now look, that does not mean the bot is going to trade $20,000. This is just, I'm setting the allocation for these 5 ticker symbols. But I've already told the bot inside of my automations that I'm running to do 2% max per symbol and no more than 1 trade per ticker symbol at a time. So that means it's not going to allocate more than $80 per symbol across the 5 symbols. Now, what do I have to adjust here? We'd have to adjust what? The positions limits. Yeah, of course. Because right now we're saying 1 position per day, 1 position total. You need to allow the bot to have 5 positions per day. So 5 new opening trades. And you want the bot to be limited to 5 positions at any one time, right? Because I'm doing 5 tickers, 1 trade in each ticker. So they all could get in today. That's why you want the daily limit to be set to 5 per day, because they all could be entered today. If all the criteria are met, they all could be entered today. And you want 5 positions in total. So here's what we're going to do. We're going to save this, and then we're going to run that automation. So we're going to click run, and then we're going to click 2% position size per symbol. And we're going to run this automation. Let it run. So here's what it's doing. Does the bot have enough capital? Yes. Is it available? Yes. That's what we're doing across the board. Well, there you go. I screwed up on that one. Okay, so what did I do wrong? Because I didn't do my calculation right. So I multiplied it by 5. So I already had the position size in here of 2%, and I 5x the capital. It actually should have been 4,000. Apologies. 4,000 here for total capital. I 5x the capital and I 5x the trades. So let me clone this one and I'll rerun it again. Clone bot portfolio, 4,000. Clone, go to bot settings. Okay, we good now? So here's what I did wrong, is I 5x because I was just multiplying it by 5, the number of ticker symbols that we needed. But we had all these already. So we were going to do $80 per symbol times the 5 that we had. That's 400. And that was going to represent 10% of our portfolio, which is 4,000. Okay, so I adjusted that down here. We will run the automation again. Multiple symbols, 2% per position size. So 2% of $4,000 is what? $80 per position. So I'm going to run this one here, run that automation, and there we go. $80 is less than we have available of 4,000. That's just 1 position at a time. So it's just going to do one contract across the board for all of these. So if you go back here to your log and you check out your log here, you can again go through that logic that it just went through. So here was the logic, SPY. Bot can open a new position. Yes, bot can open 5 positions today. Great. Bot has exactly 0 positions with this symbol. Correct. At the time I ran it, it had 0 positions in SPY. Is there a position available? Yes. Does the bot have enough capital? Yes. It only needed $80 of capital, has more, that's under our 2%, so we're good to go. So it opened a position. Across the board, this is what happened for all the positions. We didn't have anything else out there. We had no like market indicators, no SPY or no IV rank, no nothing. Now, what's going to happen if we try to run this all over again? Now, look, in the last, when we were trying to get into these positions, only 4 positions were gotten into. Does the bot have enough capital? Oof, just barely did not have enough capital. This one required $83. So this is how I know. Like, I'm looking in here like you guys do, like, wait, I was supposed to open 5 positions. Why didn't I open 5 positions? Well, because the last one here failed at the capital. It needed $83, and I said 2% of 4,000 was $80. Now, what's going to happen here the next time I run it? Do you guys want to run it again? I've got 4 positions. I said it could open 5 per day and 5 in total. So let's run it again. Let's run this scanner automation again, right? This is what happens when you turn these on. We'll run it again as multiple symbols, 2% per symbol. What's going to happen? Well, the first thing that happened is when you goes through SPY, it's going to ask questions like, can the bot open new positions? Yes, it can open 1 new position. We know that, right? It has 4. We said it could open 5. Does the bot have exactly 0 positions with SPY? No. So stop adding positions to SPY. Okay, go to the next symbol. TLT? Nope, already have a position in TLT. Next symbol. GLD? Nope, already have a position. XLU, can I open a position in XLU? Yes, I have no position in XLU, but I still fail at the capital. That's okay. Now it requires 84. So whenever it dips under 80, boom, it'll start to fire off orders to try to open that position, and that's okay. So you can see how just with these capital limits that we've set in place, we're limiting what the bot can do and also keeping our position size insanely small by default. So if the market moves a little bit and that position goes a little bit higher in premium and the risk is a little bit lower, boom, order goes over, we're good. All right, so I'm gonna do one other example here. This other example, I think, is what you guys want to do all the time. This is what I try to do a lot of times, which is you want to enter a position. You want to break up your position into multiple entries. I'm going to clone the bot so we start with a brand new, very simple version, and then go to bot settings. Okay, so I have no positions in this one. So when I go over here, and yeah, all of your stuff here is the allocations automatically readjusted to 1,000. It always goes lower. We don't want people cloning bots that they set like 100,000 and nobody looks at it, so it always gets adjusted down. Okay, so this is the last one. So this automation, this one's a little bit different. Follow along here. I have the same position loop that I had before. 5 symbols. 5 symbols, SPY, TLT, GLD, XLE, XLU. I want 1% position size per symbol, right? So every time I enter a position, I want it to be 1% with a max of 2 trades per symbol. So just like the other portfolio, I will allow a 2% position size. 1%, let me just say 1% max risk per symbol per trade, 2 trades total per symbol. So I want to get into multiple trades in the same symbol. I want to get into like 2 trades, 3, 5, 6, 7, 10 trades in one particular ticker symbol. Well, this is the concept of how you could do it inside of your bots. Maybe 1 today, 1 next week, whatever you want to do. You still have to break it down into lower and lower allocations. So if you're trying to allocate 2% per symbol, you might do 1% per trade. So that if you get into 1%, a 1% trade now and a 1% trade later, that total equals 2%. Or you could do 1%, 1%, 1%, 1%, 1%, and do 5 trades that equal 5%. However you want to slice and dice it. Okay, 1 per week is great. So we're still going to do the same thing here. Symbol price is above 200 day, whatever it is for you. I'm going to remove that so you guys know that's your placeholder. Can the bot open a position? The bot has less than the number of positions I want with this symbol. Now we don't have to say the bot has exactly 0 positions. That's when you want 1 position per symbol at a time. If you want multiple, allow the bot to continue only when it has less than your desired amount. The bot has less than 2 positions with this symbol. So it could have 0, it could have 1, but it's got to have less than 2, and less than 2 is 0 or 1. So if I want 3 positions per symbol, or 5 positions, whatever, knowing that my bot still has a limit of 10, then I could adjust that to whatever I want. Now in the next step, you say the bot last opened a position with this symbol, whatever symbol it's going through, the bot last opened a position with this symbol more than 5 days ago, more than 3 days ago. This is how you spread your trades out over time. If you just want to enter trades over time, right? If you're using some kind of market indicator, you could obviously do that as your indicator to get into a position. But you could also do a market indicator and say, you know what? I want to make sure that the last time it opened a position was more than a day ago, so I don't piggyback the same trade every day that the RSI is low. So if you want to spread your trades out, you say the bot last opened a position 5 days ago or 10 days ago or whatever. If you want to spread it out based on price, you'd have to check the price that it was below a level, and then on that yes branch, you could continue it to move forward. So that's the easy way to do it right there. It's just to say the bot last opened a position with that symbol more than 5 days ago. So if it opened a position today, then it won't keep opening a position until 5 days have passed for that symbol. And that's how you spread your trades out over time if you want to do that. And you can do it in combination stuff. Then you do the same stuff you did before. Is the position available? Like before we even check for a position available, let's just check and make sure we want the bot to enter a position. That's why logically what I try to do is I try to put all of that logic at the top. Do I want the bot to open a position? Yes, yes. Okay, great. Then is there a position available? Does the bot have enough capital to open the position? Right? And then if I do, can I just go ahead and open the position? 1% of the allocation. And Lee had a good one too. You can also do price movements in the monitors as well for multiple positions. So let's say that we have a $5,000 portfolio that we want to allocate to these 5 ticker symbols, but 1% position per trade. How many trades are we going to be able to get into for each of these symbols? We have a $5,000 portfolio and we want to allocate 1% for every entry. How many contracts are we going to be able to get into for each symbol? $50 per entry. So is a $5,000 portfolio going to cut it if we want to trade 5 symbols and do 5% or do 1% per trade? It's not going to cut it. If the average one is $80, the average $1 wide spread for a 30 delta, 70% chance of success, whatever. If that one is $80 and we are going to do a total 2% position, right? Across those positions, we need a lot more money. So if I have $8,000 and I want to do 2% per symbol spread across 2 trades, that would do it. So if I have $8,000 and I want to do a 2% position for each symbol in totality, that's $160 of risk for that symbol. But each trade is going to be how much? Because I'm going to divide that into 2 trades. Each trade is $80. So that's how we got there. So if you want to go the other way, each trade is max risk $80 times 2 trades in every symbol. That's $160 of max risk for the 2 trades that you're going to get into. If 160 is going to represent 2%, then you divide it by 2%, and there you get back to your 8,000. You can do it both ways, back and forth. What else do I need to do here? Do I need to change my daily position limits or my total position limits? You need to allow the bot to get into, and it can be actually 5 per day, because you don't need it to get into all 10, and it can't get into all 10 positions per day. So you can just leave it at 5 positions per day are opened. If it finds a new position in all the ticker symbols for that day, great, get into that. Max positions at any one time is 10 positions, 2 in each of the 5 symbols. And you know your automation is going to do this for you by default to wait 5 days for every new entry. That's right here. So that's how the combination of these safeguards plus the automations and the decisions that you're running inside of your bot can create whatever combination you want to come up with. So let's do this. Let's run this automation now. So I'm going to run 1% max risk per symbol, 2 trades at one time. I need to combine these two into this one. So here's what I'm going to do here. Last opened a position. Or no, is that the one that it failed on? Let me just see here in my log. Last opened a position with more than symbol 10 days ago. So I need to have that position in there as we go. Okay, let me adjust this here. Didn't think about that. That's why I need to test these as I go in here. So it's going to go through here, say, can the bot open a new position? Yes. Does the bot have less than 2 positions? Yes. Does the bot last open a position more than 5 days ago? Or does the bot have 0 positions is what I need to add here. So I need to go down here and say the bot has exactly 0 positions with this symbol. So I need to add an or statement. So that's how I have to adjust it there. So I was just testing my logic here. Obviously, I need to add this here. I was telling the bot it can only travel down the yes path if the bot last opened a position. Since this is the first position it's going to open, it's going to say, or the bot has exactly 0 positions. So now when I run it all over again, you guys see me doing this as you guys do it. Now that should flow through to these. Okay, so you can see here for this one, this is the one we failed on before because the bot doesn't have any history of a position. So I say, or the bot has 0 positions. Great. Continue down. Is the position available? Do I have enough capital? Yes, I can do $80. Great, open a new position. Boom, boom, boom. I should have a bunch of positions. I have 4 positions just like before. 4 positions just like before because it just rifled through and grabbed 1 position. Now I'm going to run that same automation again. This is why you have to test everything, by the way, in paper trading and use tests, because you want to make sure that logic is working the way you think it is. So now what I'm going to do is I'm going to go back here again, and I'm going to run that same automation again. Same automation. Because it's a scanner, it'll keep running. So if I run this again, now what should happen for some of these positions or some of these symbols? They should stop because the bot did not open a position more than 5 days ago. Can the bot open a new position? Yeah, it has room to open a position. Does the bot have less than 2 positions with this symbol? Yes. The bot only has 1 position with that symbol. Did the bot last open a position more than 5 days ago? No. Stop. Dead in your tracks because the last position was opened 0 days ago, aka today. So if I could fast forward time, in 5 days, it would allow another position to be entered in that ticker symbol. So some symbols might get the first position today and the next position in 5 days. Some symbols, it might get the first position tomorrow and the next position in another day. And so on and so on and so on we go. So that it can space out these trades 5 days apart for every symbol as we go. Hopefully this was helpful going through this. I wanted this to be a little bit of a workshop, so I'm glad in some cases that I forgot to add some stuff as we go. That's okay. I'm human just like you guys, and I wanted you to see how I fixed it and how we go through it and how we can get like errors and things and it not behave the way we want, and we test it all out. That's why it works that way. What I want you to understand and like breaking this down into the broad components of what we're doing. If we go back to these slides, our goal is this. Our goal is to build a portfolio with 5% max risk per ticker. I showed you how to calculate the max risk. I showed you how to do it inside of the bots so that what you can eventually get to is you can get to your bots controlling that position size for you as we go, right? When you actually get to a bot, that bot has each of those positions properly risk controlled. Like, look at this. This particular bot has $8,000 of capital, and this one position that I got into is less than its 1% allocation. And it factored it in. And now we're trading, I mean, even this little one is trading a diversified, semi-diversified list of ticker symbols. So why not do something like that as a trader? And yeah, it takes a little bit of time. It takes a little bit of effort, and that's okay. Nothing in life worth doing doesn't take a little bit of time and effort. But if you take your time through these and start to use these as a framework for how you can get into positions, it will allow you to automatically position size accordingly. Then you can do really cool things on top of these positions, like increasing the likelihood of success by adding exit options, which, by the way, I did sneakily include here inside of these automations. Now you're taking it something that has a 70% chance of success and probably pushing it to a 75 or 80% chance because you can get out earlier. And that means that sometimes positions are going to move and ebb and flow as you go. This is a good template to use just as a framework for how you can do this with a portfolio. This one here is the $3,000 Iron Condor template that I shared. And look what we do here. We do $3,000 of allocation. So I'm trying to show you one that I previously shared, but we did like a demo one. Here's a real one. I'm live trading this one right now. Okay. Have been for months and months and months. $3,000 allocation, 6 positions per day, 6 at one time. These are my 6 tickers: SPY, TLT, GLD, FXI, XRT, XLP, EEM, XLU, XOP, XBI. I think there's actually a couple more there that I have. I think it actually has more than that. Yeah, I do 10. So I do first 6 of these, whatever ones I find. Best first 6 positions every month, right? And inside this automation, look what I do. I do the same thing I just told you guys that I was building out. Does it already have a position? Like, it doesn't already have a position. Yes, it's ready. Great. Is IV in my acceptable range? Is there an opportunity? And do I have enough capital? I combine these steps in this spot where, as I broke it out earlier in your guys' example here today, I combined them in this step so you guys can see them together. And then I have opportunity filters like minimum liquidity, probability of profit, rate of return. And then I get into the position. And that's all I do. And notice here in the inputs, I just tell it my position size is 1 contract because I've scaled the portfolio down to be exactly 5% for each of those positions with a $3 wide spread. And it's fully controlled for risk. So I can let it go. I can let it run. This is why I'm comfortable saying, like, this is a portfolio a bot I was willing to share. And you guys adjust these to fit your own, but like, this should be controlled for risk if you do it right. You double check it and do it right for your portfolio. It's controlled for risk. And it's trading a diversified set of tickers across the board. And so, like, sometimes these do really well, right? Sometimes they work out, sometimes they don't. And that's okay. You can just let the winners be the winners, the losers be the losers, right? That's okay. That's fine. That's what you want. I know that this was not an easy concept. I think I talked about in the beginning of, like, you really have to lean into this one. You really have to lean into this one. But it's one that people don't do. Like, as much as we pound the pavement on it and the math just is the math on probabilities and expected outcomes and likelihood of blowing up, people just don't do it. And if you do it, you're ahead of the game. So please take the time to understand how the math works, build it into your bots so that you can do it automatically. So that your bots can scale up and scale down automatically for you, can avoid entering positions because position sizing is bad right now. And that's okay. That's what I want my bots to do. I want my bots to avoid entering a position when it's risking too much because the math doesn't lie on that stuff. And you're only one bad event away from a cascading series of sequence of returns that puts you in the grave. You don't want to do that. Okay. Have a great rest of your day. Thank you so much for being here. I belabored this long enough. If you guys enjoyed this, let other people know, send some other people to Option Alpha. Really appreciate it. Can't wait to show you guys what we have for you tomorrow. Drop it in the community. You guys are going to love it, and have a great rest of your day. Until next time, happy trading.